Imagine you have $200,000 sitting in your mortgage offset account. Should you leave all of it there, where it is safe? Or should you invest some of it into an S&P 500 index fund? The answer may not be one or the other. For many people, the smarter approach could be to use both. Let's look at a simple example. Assume you have an $800,000 mortgage with an interest rate of 6.1%. If you keep $200,000 in your offset account, the bank effectively calculates interest on only $600,000. That $200,000 could save you approximately $12,300 in mortgage interest during the first year. This saving is relatively predictable, immediately useful, and generally does not create taxable investment income. That is a strong financial return. But there is a trade-off. If every available dollar remains in the offset account indefinitely, you may reduce your mortgage interest, but you are not building a separate growth asset. Now, consider a second strategy. Assume your essential household expenses are $6,000 per month. A 12-month emergency buffer would therefore be $72,000. Instead of investing all your cash, you keep that $72,000 inside the offset account. It remains accessible for emergencies, continues reducing your mortgage interest, and could cover an entire year of essential expenses. The remaining $128,000 is invested in a diversified S&P 500 index fund. For this example, we will assume 8% annual capital growth and a 1% distribution, creating an expected total return of 9%. At 9%, the investment's expected first-year return would be approximately $11,520 before tax and fees. Meanwhile, the $72,000 remaining in the offset could save approximately $4,428 in mortgage interest. Combined, the hybrid strategy produces an expected first-year benefit of approximately $15,948. That is higher than the $12,300 produced by keeping everything in the offset. But there is one major difference. The offset saving is relatively predictable. The investment return is not. The stock market could decline by 20, 30, or even 40% during a bad year. If the market fell by 30%, the $128,000 investment could temporarily fall to around $89,600. That is why investing your entire emergency fund can be dangerous. If you lose your job during a market downturn, you may be forced to sell investments when prices are down. But with 12 months of expenses still protected inside the offset account, you have time. You do not need to panic. You do not need to sell immediately. And your long-term investment has time to recover. The practical framework is simple. First, calculate your essential monthly expenses. Second, decide whether you need 6 months, 9 months, or 12 months of financial protection. Your decision should reflect your job security, family responsibilities, insurance coverage, and comfort with risk. Keep that emergency buffer in the offset account. Then consider investing only the money above that buffer provided, you will not need it for at least 7 to 10 years, and you can tolerate significant market falls. The offset account protects your present. The index fund helps build your future. You do not necessarily need to choose between security and growth. Build your security first. Then use the surplus to build wealth. This video is general education only and does not constitute personal financial advice.